Somewhere between a factory floor in Chicago and a customs checkpoint in Guangdong, a US-made electric motor shut down. Not because of a software glitch or a mechanical flaw, but because of a missing part, something smaller than a breath mint, a rare earth magnet. China, which dominates global supply, had just stopped exporting them. And Ford didn't wait around for a solution. They shut down the entire production line. Now American manufacturers are quietly saying what was once unthinkable. What if we just move the whole operation to China? 5 years of tariffs, trade wars, and reshoring rhetoric. And here we are, contemplating sending more manufacturing into the very supply chain we were trying to escape. What was billed as decoupling has been flipped into a trap, one carefully set by Beijing. In April, China's exports to the US fell 21%. But the real shock came from the US side. Exports to China collapsed by 77% in just 1 month, falling from 265,500 to 57,300 ocean containers, according to Pangea data. This freeze came on the heels of Trump's new round of reciprocal tariffs. But the fallout is doing more than freezing trade. It's shifting the very structure of global manufacturing. Now, major US automakers, fearing they'll be paralyzed by rare earth shortages, are seriously weighing whether to move motor production to China, simply to bypass Beijing's tightening grip on magnet exports. The plan to bring factories back home is backfiring. It's pushing them deeper into China's orbit. And while American supply chains slow to a crawl, China is accelerating somewhere else. From January through April 2025, Beijing's trade surplus with Europe hit a record $90 billion. Analysts expect it to surpass $250 billion by year-end. At the same time, US ocean exports fell by 78% in April alone. Chinese exporters, faced with rising US barriers, are simply rerouting, leveraging a weaker yuan, which just hit a 13-year low against the euro, to flood European markets with cheaper goods. With post-tariff disruptions hurting French and German importers, Chinese supply is being snapped up fast. American shipping lanes are going quiet, and Beijing is finding new customers. But trade isn't the only fight. It's also about who absorbs the pain. Facing rising backlash from inflation-weary consumers, U.S. retail giants are now demanding Chinese suppliers cover up to 66% of Trump's new tariffs. But those manufacturers, already squeezed by razor-thin margins, aren't giving in. They're slashing prices by 5 to 10%, refusing some deals outright, and shifting exports toward Asia, the Middle East, and Europe, places with rising demand and fewer restrictions. Some speculate that China may be subsidizing U.S. importers behind the scenes, but there's no real evidence to support that. And economically, it doesn't add up. If exporters eat the tariffs, they risk collapse. If retailers do, prices soar. If consumers do, demand craters. No matter who pays, the damage is already rewriting global logistics, and new factories are opening in places Washington never intended. Trump's tariffs were meant to punish China and bring U.S. industry home. But April's numbers tell a different story. Retaliatory tariffs from Beijing have pushed duties on U.S. goods into the triple digits, particularly for high-value industrial inputs. U.S. steel production still depends on imports for over a quarter of its supply. Aluminum? Nearly half. With doubled tariffs on both, American manufacturing is choking on its own cost structure. The speeches say reshoring, but the reality? Factory orders are drying up. And for the products that do get made, there's no guarantee they'll be finished. With China tightening export controls on rare earth magnets, essential for everything from electric vehicles to military systems, American automakers are facing a hard choice: find alternatives fast or shut down. China now controls over 90% of the global magnet supply, and it's requiring new export licenses that are being delayed or denied entirely. So what started as a trade strategy to decouple from China has turned into a deeper entanglement. The U.S. wanted independence. Instead, it's running out of parts, out of time, and maybe out of moves. According to reporting by the Wall Street Journal, several major U.S. automakers are now actively considering shifting parts of their production to China, not for cost savings, but for survival. Under the current set of restrictions, raw rare earth magnets can no longer be exported from China. But there's a catch. If those same magnets are embedded inside a finished motor, they're free to leave the country. The loophole is legal. The implications are anything but clear. Ford, for example, was forced to halt production at its Chicago Explorer plant back in May due to a sudden shortage of magnets. One supply chain executive summed up the new reality plainly. If you want to export a magnet, they won't let you. But if it's inside a motor, you can. And so we find ourselves in a strange new chapter of economic warfare. One where the tactics are clever, the rules are blurry, and the scoreboard tells a very different story than the one we were promised. Remember the narrative? Tariffs were supposed to bring factories back to the U.S., to pressure Beijing into compromise, to rebalance global trade. Instead, U.S. exports to China plunged 77% in just 1 month. And the so-called reshoring wave? It's not happening. In fact, the opposite is underway. American manufacturers are exploring the construction of entirely new production lines inside China, not for market expansion, but just to keep existing assembly lines moving, not to grow but to avoid collapse. Ford's plant shutdown is not an isolated case, it's a warning shot. The magnet shortage didn't just slow down one factory. It exposed how deeply American manufacturing still relies on components made thousands of miles away, often under the control of a strategic competitor. And now, rather than cut dependency, U.S. automakers are considering moving even more of their operations overseas, just to legally access components that were once a routine import. The logic is cold but hard to argue with. A new factory might cost hundreds of millions to build. But a halted production line, one that employs thousands and feeds an entire regional economy, could cost billions. This isn't just a story about motors and magnets. It's a story about leverage. Because while the U.S. aimed to tighten the economic noose around Beijing, China was quietly developing its own pressure points. And now it's pulling the strings. China isn't just enduring this economic standoff, it's recalibrating. According to Apollo Research, U.S. companies generate over $1.1 trillion annually from Chinese consumers. That's not just business, that's lifeblood. And it's now at risk. Beijing is actively redirecting consumer demand toward domestic brands. Data from Chinese exchanges shows that 85 to 90% of listed companies' revenue now comes from local buyers. U.S. market share has plummeted into the single digits in just the first 4 months of 2025. China is running a massive budget deficit, $370 billion so far this year, up 50%, and pouring that cash into stimulus designed to boost internal consumption. The results are already showing. Luckin Coffee is stealing ground from Starbucks. Xiaomi is undercutting Apple in both price and popularity. And none of this was caused by official bans or hostile rhetoric. It's happening through quiet substitution. U.S. brands aren't being kicked out, they're being replaced. Voluntarily, gradually, effectively. And the pivot is far from over. The most striking part? Beijing hasn't even issued a full-scale directive yet. The system is adapting on its own. Meanwhile, Washington is stuck reacting to symptoms of a deeper vulnerability, without yet addressing the core disease. The legal backdoor that no one anticipated has now become the main route. You can't import a Chinese rare earth magnet directly, but you can import a motor that contains it, as long as that motor is assembled in China. That single technicality is now reshaping entire production strategies. The Wall Street Journal confirms that this loophole is driving U.S. automakers to explore relocating motor production to China. Not because they want to, but because they may have no other choice. Supply chain math is unforgiving. You either spend to move your factory or bleed money every day your line stays idle. The ban was meant to isolate China. Instead, it's sucking Western manufacturers deeper into its ecosystem. And now China has gone a step further. Last week, it activated a national tracking system that requires rare earth producers to disclose buyer names and trading volumes. This isn't just bureaucracy, it's surveillance. Real-time tracking means Beijing now has full visibility into where its minerals are going and who's using them. It also means it can shut off supply instantly, without needing to pass a new law or issue a public announcement. This comes on the heels of April's new licensing rules and represents a sharp escalation. It's no longer about tariffs. It's about control. Strategic control. Supply chain control. Industrial warfare played out in spreadsheets and shipping manifests. While the U.S. blocks AI chip exports to China, Beijing is choking off American access to elements like terbium, dysprosium, and scandium, materials that are essential to everything from electric vehicles to advanced weaponry. What started as a tit-for-tat trade dispute has evolved into something far more consequential. A game of industrial chess where every move targets a critical node in the opponent's economy. And the board isn't level. One side owns the raw materials. The other side is still hooked on the imports. So here we are, facing the unraveling of a story we told ourselves for years. That tariffs would bring American factories home. That China would blink. That the trade war would end with jobs returning and balance restored. But that story is falling apart. Instead of a homecoming, we're watching a quiet exodus. U.S. companies are renegotiating leases in China. American brands are being pushed aside in favor of local alternatives. The export war hasn't brought a return. It's triggered a migration. And the next round of this conflict won't be decided in courtrooms or press briefings. It will be decided in motor casings, chip foundries, and battery plants. Places most of us never see, but that power the modern economy. The question now isn't whether tariffs worked. It's whether the U.S. can adapt fast enough to survive being locked out of the very supply chains it once chose to offshore. Or are we already too far behind to rebuild what we gave away? Let us know what you think. Drop a comment, share your thoughts, and if you thought the trade war was over, think again. Beijing just locked the next door, and the game is still very much on.